The TEK2day podcast is brought to you by SS&C Technologies, a global market-leading provider of cloud-based investment accounting software services in fund administration. SS&C's AI-powered investment operations and accounting platform, Singularity, provides real-time, multi-basis accounting across a wide range of asset types with unparalleled automation and operational efficiency. Singularity is offered on a software-as-a-service basis or via SmartSource, SS&C's intelligent middle and back office accounting service. For more information, visit ssctech.com/singularity. Welcome to the TEK2day podcast powered by CEO Rater. It's your host, John Mayetta. Check us out online at TEK2day.com. I would encourage everybody to subscribe to our email newsletter at TEK2day.com, which is simply an email notification that goes out every time we publish a piece of content. The reason being that for every podcast that I do, we publish maybe 10 articles at TEK2day. It's just a heck of a lot easier to get an article out the door than it is to get a podcast out the door. The podcasts are not the most efficient piece of content marketing. So I'd encourage you to subscribe to that email newsletter. I don't know how much we publish in a week. It depends on a week. Sometimes it's one article. Sometimes it's half a dozen articles. And I'd say 90% of what we publish is free. So check that out. Yesterday we published a piece around today's Fed meeting. And our expectation is that on the printing side, Fed policy is not going to change, right? They're going to continue to spend approximately $125 billion a month, maintaining low interest rates. You'll continue to see the Fed monetize the fiscal debt. You'll continue to see the Fed monetize any future fiscal stimulus that will come down the pike. And the only difference will be that the 2% band, the Fed has had a 2% tolerance rate around CPI increases. And my expectation is that they'll raise that 2% at the meetings this week because you're going to have more than a 2% increase in CPI given the amount of printing that's occurred year to date and that's going to occur for the foreseeable future. There's no way around it. They continue to inflate the equity bubble that we're all living in, where all news is good news. Facebook put out a piece yesterday that said their ad network is going to be materially impacted negatively when Apple eventually rolls out iOS 14. Nobody wanted to hear that news. Stock was up more than 8% given I think somebody put out a piece yesterday around the e-commerce opportunity, which is real. We've talked about that for more than a couple of years here. The company's talked about monetizing its network through e-commerce payments, so on and so forth. It's a no-brainer. That's the playbook that PayPal pursued in the late 90s. That's the strategy that Venmo used to build its peer-to-peer payment network. And, of course, Venmo now owned by PayPal. But given the sensitivity around e-commerce today, given COVID, anything e-commerce, you say the words e-commerce, that's automatically $1 billion valuation. Right? If a startup goes out the door with no revenue, a little bit of venture backing, and they're in the e-commerce space, it's an automatic $1 billion valuation. So it's out of control out there. I think it was the head of equities for T. Rowe Price was on yesterday talking about that if you look X number of years out, stocks are fairly valued. And look, I get it. It's when most everything's expensive, it's not easy to allocate capital if you're on the equity side. But there are names out there that are less expensive. Right. But what's going on is people are just gunning these momentum names to try to get every last piece of performance out before they bail on those names. So I don't know how they reconcile that in terms of their fiduciary responsibility, but that's their problem, not my problem. So subscribe to the newsletter. That's all for now. See y'all next time.